You are welcome to another video. So in today's video, we'll be looking at single entry and incomplete records. Firstly, what do you mean by single entry? When we talk about single entry, it's just like a system of accounts whereby it ignores two further aspects of each transaction. Now let's recall back to our dual concepts. Now the dual concept state that we have two sides, right? The first one is that the first side will be debited and the other account will be credited. But in the case of single entry, the dual concept is not applied. So that is why it's called single entry. Now, the term incomplete record is applied to a system of single entry. So if you have a single entry system, the term incomplete record, because the records are not complete. And for that reason, we cannot create the arithmetic accuracy of the account. That is, we cannot prepare the trial balance since we don't have a dual concept being applied to this transaction. Now let's start with what are the features. What features can we see to say that yes, this is a single entry transaction? Number one thing there is that personal accounts are the one being created. It only creates or ascertain the personal account of, and the personal account, don't forget, the personal account I'm talking about is the sales ledger control account. That it shows the goods you bought on credit or goods sold on credit, and the other account, which is the purchase ledger, and that one is talking about goods being purchased on credit. Also, real accounts and nominal accounts are not put into consideration under single entry and incomplete records. And another thing there is that another feature is there, as I said the other time, the transaction does not apply, we cannot apply the rule of double entry to this transaction, so we will not be able to prepare the arithmetic accuracy, that is the trial balance. And when we are talking about the advantage, it is very easy and simple to operate. Yeah, you know that that is very easy and simple to operate. And the disadvantage here, as I said earlier, that trial balance, we cannot prepare that, and so on and so forth. But don't forget, since it is an incomplete record, you'll be wondering that can we see ascertain our profit and loss? Yes, you can ascertain our profit and loss using incomplete record. And how do we go about that? That is what we are going to look at now. The number one step to ascertain your profit and loss in single entry and incomplete record is by creating what we call statement of affairs. So let's start. Ascertainment of profit or loss. So the step one, we will need to create a statement of affairs. So this statement of affairs, I'm going to call it opening statement. The opening statement of affairs. That's the first one. Now, what do we mean by opening statement of affairs? This is relating to our balance sheet, which we usually call statement of financial position. So, statement of financial position, when you are dealing with single entry and incomplete record, is reversed to a statement of affairs. Now, to ascertain your the first step I said earlier is you opening the statement of affairs for the beginning. Now, this statement of affairs is used to determine the opening capital. So under it, you say that to determine the opening capital. The second step is to also create a statement of affairs. Step two, statement of affairs. So this will be called the closing statement of affairs. And we use this to determine the closing capital. Determine the closing capital. Now, the idea behind this is that don't forget, since proper book of accounts is not kept, but the owner of that business will be able to record that, okay, when I started this business, this is the amount I used to start the business, and these are the things I used to start the business, these are the expenses and the income, the assets I have. So that is for the statement of affairs at the beginning, and we'll use that to determine our capital. How do we determine our capital? We'll recall back to our accounting equation. Accounting equation state that capital is equals to asset minus liability. So when we determine all our assets and our liability, so when we subtract our assets, our liability from the asset, the result is the capital. So the capital we use to start the business will be ascertained in the opening statement of affairs. For the second one, which is the closing statement of affairs, we also use that to determine our capital, and some adjustment also will be made, whether there is there is a drawing of goods, additional capital. So all those adjustments will be made there in the closing statement of affairs. Now the idea there is that when you start your business with 5,000, that is the capital at the beginning, and at the end the capital is 7,000. If you look at this now, you can see that your capital has increased. This simply means that there is a profit. So you determine your opening statement of affairs, determine your closing statement of affairs. So the statement of profit there is going to be the difference between your closing statement of affairs and the opening statement of affairs. Now the third step is the statement of profit. Statement of profit. So as that, you don't know the date, right? Let me just put X. For your statement of profit, as I said earlier, you will first determine your closing statement of capital, your capital for the closing statement of affairs. So the closing capital, we'll call that the closing capital. If this is your closing capital, now you may have already made some drawing during the year. So those drawings, those goods you withdraw for your own use or domestic purpose, you are going to add that to your closing capital. Add drawings. Then the balance will be here. Now, the opening statement, what you use to start the business, will be subtracted. So you are going to less that. Less opening capital. So the amount will be here. And also, during the year, you may add to your capital, and that is called additional capital. You are going to add that to your opening capital. Additional capital. The sum of these two will move to this side. Then you can see that I bracket it. So what I bracket there simply means that you are going to less it. Then the balance will be here. The balance below there is called the net profit. So in single entry and incomplete record, this is how we compute our profits. Another step there is that we may ask to prepare the statement of financial position. So that's the last step here. Step 4, statement of financial position. Now for the statement of financial position, e similar to your closing statement of affairs. But here now we have gotten the net profits. The net profits will be added to the capital, your opening capital, that is the capital at the beginning, opening capital. Your net profit will be added to your opening capital, then which is going to move to your statement of affairs. So the statement of affairs is used, statement of financial position. So we want to know how solvent the company is. That's why we prepare our statement of financial position. Now let's look at a problem shortly. So here's an icon question. Let's solve these problems together. The first statement says that Uncle Orobo, the proprietor of a sewing machine shops, keeps books of accounts for the year ended 31st December 2000. It shows that it doesn't keep proper books of accounts, and you can see the records, right? So in a nutshell, we are asked to prepare profit and loss, and also the statement of financial position. And don't forget the step one I gave to you guys the other time. I said step one. The step one is to prepare the statement of affairs in order to ascertain the opening capital. Before you can get the profit and loss for the year, before you can compute the profit and loss, you need to determine your opening capital and your closing capital. So you are starting with statement of affairs. But before we move on, the first thing to do is to write the name of the person that owns the account. So the name of the person that owns the account is Uncle Orobo. And the first step, statement of affairs. So for the beginning, which is January 1st, 2000, as at January 1st, 2000, we are going to start with a non-current asset. Non-current asset. Let's look at the transactions we have. We have a non-current asset there, which is furniture and fitting and also delivery vans. So we have furniture and fitting, fittings, and that is 16. Don't forget the naira, we can see that there's a common 00. It simply means that the original amount has been divided by 1000 naira. So that's why we're having common 100 at the top. For delivery vans, that is 28.8. So do we have any non-current asset again? Nothing. So we move to current assets. Current assets. The first current asset there is cash in hand. So the cash in hand is 3.2. The next one is stock. Stock is also known as inventory, and that is 63.2. We also have debtors, and that is 99.2. We have bill receivables, that's 24.8. So we are done with 1, 2, 3. Let's add this up. Give me what? 3.2 plus 163.2 plus 99.2 plus 24.8. So that is 290.4. And at the beginning here we have 44.4. So let me combine that. 16 plus 28.8. That's 44.8. We are going to add this up to 40.4. That's 335.2. So let's solve for the current liabilities. Current liabilities. For the current liabilities, we have bill payables. The bill payables is 17.68. Then we have bank overdraft. That is 144 naira. Then we have creditors, which is 72.96. That's all. Let's add this up. 17.68 plus 144 plus 72.96. That is 234.64. So you can see that bracket is, this simply means we are going to less it. Then we have 335 rather, 0.2 minus 234.64. That is 100.56. So the difference here is going to be the capital. Then you can write out the formula by saying that capital is equal to assets minus liabilities. Now we have determined the opening capital. The opening capital is 100.56. Let me write that down. Opening capital 100.56. So the closing statement of affairs. Statement of affairs as at 31st December 2000. So we are going to start with our non-current assets. Non-current assets. So for the non-current assets, we have furniture and fittings. But one thing you should note is that there's an additional information, and all those additional information is starting to tell us what happened during the year, right? During the year, Mr. Orobo gave us part of his stock gave part of his stock to his niece as a gift, which cost him 9,600. He makes cash drawings from his business for personal use. So all this is drawings, right? We also have an additional information which say that write off a bad debt of 2,400, provide 15% depreciation of furniture and fittings, and also 20% on delivery van. So here we are going to provide for the depreciation on furniture and fitting. Don't forget the furniture and fitting is for 31st December. That is 16, right? To calculate it is going to be 16 multiplied by the depreciation percentage, that is 15%, multiplied by 15 divided by 100. So this is for furniture and fittings. We have 16 multiplied by 15 divided by 100. That is 2.4. This simply means that the cost, the original cost is what, 16. Depreciation, that is 2.4. Then this is going to be the net book value. The net book value after lessing our depreciation from the cost, that's going to be 16 minus 2.4, which is 13.6. The next one we have delivery van. For the delivery van, we have to make a provision of 20% for the depreciation. So depreciation for the delivery van is equal to the amount as at 31st December 2000. That's going to be 28.8. Then the percentage, which is 20%. So this can go here. This is 5. It's going to be 28.8 divided by 5, which is 5.76. So the cost is 28.8, depreciation which is 5.76. Then the net book value minus 5.76, that's going to be 23.04. So this is for the non-current assets. I'm going to add up. Let's move to current assets. For the current assets, starting with stock. So stock at the end is we have 163.2. Sorry, 169.2. Then debtor. At the end is 78.4. But don't forget, we are going to make a provision because there's an additional information which talk about we writing off bad debt of 2,400. That is, maybe the customer cannot pay again. So we need to write off from our debtors balance. So we have the debtor at the end to be 78.4, then minus the bad debt we have to write off, which is 24. Don't forget, we have 2,400, but we are writing our amount. The amount is written in terms of 1,000. That is, you are dividing the original amount by 1,000. So it's going to be 2,400. This amount, 2,400 divided by 100. Sorry, divided by 1,000 rather. That's going to give us 2.4. So this our bad debt, which is 2,400. When we write it in this form, it's going to be 2.4. So we are deducting 2.4 from 78.4. Do you get the logic now? So the balance there is going to be 4 minus 2.4, 76. Then the next one, we have bill receivables. Bills receivable. For bill receivable, that is 25.6. Then what else? We have cash in hand. For cash in hand, that is 7.12. 1, 2, 3, 4. So that is all about current assets. Now let's add it up. 76 plus 25.6 plus 7.12, then plus 179.2. So this gives 287.92. Let's add this up also. Here we have 6, 4. We have 6, we have 3. So the overall is going to be plus 36.64. So we have 324.56 as our assets. Now let's write out the current liabilities. For the current liability, we are starting with bank overdraft. So for bank overdraft, as at the end, we have 112 naira. Then the next is creditors. At the end, that is 67.2. The last one, bills payable. So at the end, we have 17.6. Adding this up, don't forget we are lessing current liabilities. 112 plus 67.2 plus 17.6. So that gives 196.8. And we are going to less it 324.56 minus 196.8. That's 127.76. So this is the capital. And don't forget, as I said the other time, capital is equal to assets minus liabilities. So I've gotten the closing capital. So let's compute the profit now. Since we have determined the opening capital and the closing capital for the year. So statement of profit or loss for the year ended, that is going to be 31st December 2000. So we have our naira to be in this form. As I said the other time, your closing capital less your opening capital. That's what's going to give you your profit. But if there's other thing like drawings and additional capital, we are going to adjust that in it. So we are starting with our closing capital. Closing capital. The closing capital, when we solved it the other time, we got 127.76. Now, don't forget, from the additional information here, we are giving drawings. During the year, Uncle Orobos gave out part of his stocks to a niece as a gift, which cost him 9,600. Also, he makes cash drawings from his business for personal use, which is 1,040 for that year. So, using money for personal use is a drawing, and you giving out from your capital to your friends, your needs, or your relatives is also a drawing. Therefore, we are going to add the two money together. That is going to be the total drawing for the year. So we are adding drawings to our closing capital. So we have drawings. The first amount is 9,600. Now, don't forget our money is in terms of 1,000, as I said the other time. It simply means that the original amount is divided by 1,000. That's why we are having to 100,000 here. Therefore, this amount, which is 9,600 and 11,040, will be divided by 1,000. The first one, 9,600 divided by 1,000, that's 9.6. The second one, which is 11,040 divided by 1,000, that is 11.04. So let's move here. We have 9.6 plus 11.04. Now let's add that up together. We have 4, 6, 1 plus that's 10. Then plus 1, we are going to have 2. Now the addition of these two is going to be, we have 10 here plus 1, that is 8, 14. Plus 1, we have 8, 4, and 1. Then less I said we are going to less our opening capital. Opening capital. At this capital at the beginning. The opening capital, and also one thing you should note, is there additional capital? If there's an additional capital, we're also going to less that. No additional capital from the formation given. So we just less our closing capital. Closing capital is that's 100.56. Now let's less this. To less this, you borrow one from here, we have 7, 14, 13, 10. So subtracting this, we have 4, 5, 7. Sorry, 4.8, then 7, 7, 4, 0. So we have 47.84. 47.84 is the net profit for the year. Now, after we have gotten our net profit, the next thing we have to do is to prepare the statement of financial position. Now, let's move to the statement of financial position. Statement of financial position as at 31st December 2000. So this statement of financial position is similar to the closing statement of affairs. The only difference there is that we are going to write out our capital and add the net profit. Capital at the beginning and add the net profit. Now this is how it works. Starting with our non-current assets. Non-current assets. So we have furniture and fittings. Furniture and fittings. Now don't forget, I said it the other time, cost, depreciation, and net book value. So the cost for the furniture and fitting is 16 naira. And we have to depreciate it, which is 15%. The 15% is 2.4, and the difference, that is 13.6. The second one, that is delivery van. The cost is 28.8. So 28.8 multiplied by 20. That I'm trying to calculate the depreciation. We worked out the other time. That's 5.76. Then when we subtract it, minus 5.76. That's 23.04. So this is the total non-current assets. Now let's move to our current assets. For the current assets, starting with cash in hand. Cash in hand, that is 3.2. Then we have stock. For the stock, so the cash in hand at the end is 7.12. For the stock, we have 179.2. Debtors. Don't forget, I said the debtors, we are making an adjustment. So 78.4, then we are lessing the bad debt. And bad debt, the amount there given for bad debt is 2,400. Since we are writing in terms of 1,000, we are going to divide 2,400 by 1,000. That's 2.4. So we are lessing 2.4 from 78.4. That gives 76. We have bill receivables. For the bill receivables, the balance is 25.6. So that's all. Let's add up all this plus 25.6 plus 179.2. Adding up all this, we have 287.96. So the addition of everything, that is 324.56. Or let's just leave it like this. Less current liabilities. So starting with creditors. For the creditors, we have 67.2. Bills payable, that is 17.6. Then bank overdraft, that is 112. So the addition of all this, 67.2 plus 17.6 plus 112, we have 196.8. So we less that from 324.56. So that is 127.76. Financed by, the first is the capital, and I said the capital is going to be the opening capital. You know that the opening capital is 156. Then the net profit, the balance you are seeing here is for the net profit, which is 47.84. And don't forget, we had drawings. The drawings, which is 9,600, and the other one, that is 11,040. So when you add up the two, you are going to divide it by 1,000 because we are writing it in terms of this. Divide by 1,000. That is less drawings. I said the drawings is 20.64. So when we less it, 47.84 minus 20.64, that is 27.2. So adding this up, 156 plus is going to give us 127.76. Now let's look at it. Yes, it's correct. So we have come to the end of the video. Thank you for watching. Please don't forget to like, share, and subscribe to my channel. Bye.